Hi, everyone. Thanks for joining us for this conversation with our esteemed panel. As a reminder, we're set to have a panel to discuss what early stage investors look for in marketplace investments. I'm the moderator for this conversation. I'm Al Guerrero, the managing director at Silicon Valley Bank based out of Los Angeles. As you might know, we're a commercial bank exclusively focused on banking the innovation economy. As a result, we bank close to 50% of all VC-backed companies and around 65% of all the VCs. And it's an honor for me to moderate this panel. Let me first start by introducing our panelists. First, we have Miura-Ko, co-founding partner at Floodgate, a seed stage venture fund based in Palo Alto. Anne, would love if you could spend a few minutes introducing yourself and your fund to the audience, please.
Great. Yeah, thank you so much. I'm Anne Miura-Ko. Floodgate is a 12-year-old early stage venture capital firm. We are specialized in what I would call pre-seed and seed investing, anything before you hit product market fit. We believe that that's a very different motion than when you are in growth mode. We love to think of ourselves as co-conspirators with founders. We are generalists in the sense that we are not focused on a particular space. And so we do about 50% consumer, 50% enterprise, but we have a long history investing into marketplaces going back to 2008. My very first investment was TaskRabbit, and my second investment was Zimride, which eventually became Lyft, where I still sit on the board.
Awesome. Thank you, Anne. Second, we have Daniel Hoffer, managing director at Autotech Ventures, an early stage venture fund based out of Menlo Park. Daniel?
Thank you, Al. Yes, my name is Daniel Hoffer, and I am a managing director at Autotech. Autotech is a Silicon Valley-based venture capital firm focused exclusively on the ground transportation industry. So we tend to invest all over the world. We are, many of our deals are in the US, but we also have a bunch of companies in Europe, a few in Canada, one even in Dubai. And so we take a global perspective to the ground transportation industry. We're interested in marketplaces for sure. We also invest in deep tech, things like autonomous AI, semiconductors, and business model innovations in fintech and SaaS in addition to marketplaces. We're an early stage investor. Generally, seed through Series B is our sweet spot. Initial check size 1 to 5 million. We can lead rounds or follow. We also have many corporate LPs as investors in our fund, and one of our differentiators is the network that we bring to bear for our portfolio companies. We actively facilitate introductions between our portfolio companies and the corporate investors in our fund, as well as many other large corporations from the transportation industry in our network. And so we aim to be the most value add investor in a syndicate with a particular focus on the ground transportation unique dynamics that we can provide.
Awesome. Thank you, Daniel. And so as a reminder to the audience, we have a little less than 30 minutes. So I'd love to ask questions for about 20 and then take some questions from the audience for the last 10 minutes. I already see some questions coming in, which is awesome. Please keep them coming. This session is really for you to leverage the brain power of the panelists here. So feel free to start sending some questions, but let me kick it off. So with the pandemic, I would be curious to hear how COVID has impacted your investment thesis, sectors that maybe you're now more bullish on or possibly even bearish on. How has COVID kind of impacted what you focus on? Anne, do you want to take that?
Yeah. So I think that we've been thinking about it in various ways as the pandemic has progressed. Initially, we were really worried that financings would come to a screeching halt. That's definitely proven to be untrue. What I think it's exposed is really interesting that digitization is actually a superpower. And so this is an incredible opportunity for the tech sector, and we've seen that reflected in the markets. And so the two things that I would think about, one is making sure that the product market fit that you think you have is not COVID market fit. And we're being very careful about that with our portfolio companies, because there are some companies that have significant tailwinds as a result of digitization and the change in consumer behavior. We want to make sure that those behaviors persist. And then the second thing that we're thinking actively about is the fact that it's the flip side of that, which is the specific sectors where there's been significant challenges. And so obviously where we look at travel, or where we look at restaurant industries as a specific customer set, it's been very challenged. We don't know exactly when those sectors will recover. And so because we are sensitive to market timing also, those are sectors where we're being more careful about making active investments.
And just out of curiosity, on the sectors that are seeing tailwinds, what sector in particular, or what sectors in particular are you focused on, or do you think are seeing a COVID bump, but not necessarily going to be able to keep that momentum going post-COVID?
Yeah, one area where I would say is a good example of COVID market fit is digitization of kids' activities, right? I'm a parent to a 13, 11, and 9-year-old. There is no way that they're going to continue doing soccer on Zoom after they're able to do it in person. And so, I think that there are certain opportunities in education, but I'm a little bit reticent to say that this is sort of the way things will be even after COVID.
Yeah, that's a great point. I definitely need to keep my kids active, and so they need to get off of Zoom and playing video games. Daniel, anything you want to add to that?
Yeah, a few things. So first of all, internally, we talk about how some companies are COVID positive or COVID negative, and it's along the same lines as what Anne was saying. You know, some really benefit from the trend, some are really hurt by the trend, and it has nothing at all to do with the quality of the business. And it's not their fault. They could be the best, travel company in the world or restaurant company in the world. It just doesn't matter. But they're still being hit or benefiting. And from an investment perspective, from a VC perspective, the way it will show up is in the year-over-year trends. And so you see some of these companies and they're skyrocketing this year, and the founders are all excited, and they're excited to show the hockey stick chart, and the investors are all excited because we love hockey stick charts. But next year, the year-over-year metrics will tank, we presume, right? And so we need to take, as VCs, we have generally a 10-year horizon for our funds. We take a 10-year perspective, and so we need to think not just what will it look like next year or this past year, but as Anne mentioned, what does it look like 5 to 10 years out? And so we've seen some of our companies, and I think this is true for pretty much every VC. Some of the companies in our portfolio are very COVID positive, and some are not. We're investors in a company called Outdoorsy, which is a marketplace for RVs, and for it's kind of the Airbnb of RVs, and they are going through the roof, and they are skyrocketing, and it's a fantastic company, and they were going through the roof before COVID as well, but it has really accelerated, and so. We're sensitive to these dynamics, but you have to kind of see through it, and you have to take a long-term perspective.
No, I think that makes sense. So let's jump into the heart of the theme of the panel. I'd love to get some thoughts into how you evaluate marketplace startups, both qualitatively and quantitatively, at the seed stage and then at the Series A. And maybe Anne, you could take the seed stage perspective, and then Daniel, if you could take the Series A perspective, that would be great. Anne, any thoughts on how you evaluate? You touched upon it a bit during the introduction, but I'd love to hear a bit more specifically as it relates to marketplaces.
Yeah, so for seed stage and pre-product market fit, there aren't many indicators, so it's not really about metrics. The way we think about it is, first of all, with founders, we recognize that the best founders are not iterating to the future, they're designing the future. And so what we're trying to imagine is, what is the future that they're trying to enable, right? And so if you look at, as an example, one of the big mistakes that I made was passing on Airbnb. And it was partially because we were looking at what it is at that moment. It was airbed and breakfast, airbeds in someone's living room, They were also selling cereal boxes and had more in sales in cereal boxes than in airbeds. And you're just saying, okay, is this a great business or not? That's not the way to assess it. It's sort of, what is that future vision? Taking that into account, what we're also trying to do is say, okay, there's some sort of hockey stick, as Dan has mentioned already, that we're trying to imagine. Usually there's an insight around why adoption of something is going to hockey stick in the near future. And hopefully that insight is somewhat controversial. And so understanding what is it that they're seeing in the market that causes this new opportunity to be possible today, that's something that we're looking at closely. And oftentimes an inflection is because of a societal belief or that has changed fundamentally, or it's a technology change that has happened, or it is a regulatory change that we believe will happen, right? I think that the most interesting ones right now are around regulatory changes. So telemedicine is a really good example of that. The other one that I think we're paying a lot of attention to right now is societal beliefs. So because of COVID, we've seen a dramatic change in the way people spend money on the consumer side that has never happened before. And so it's a reflection of COVID, but because people are being pushed into new behaviors, that they're saying, that actually isn't too bad. We actually believe that societal beliefs will actually change much more dramatically in the next year to 2 years than they ever have. And so that leads to massive adoption changes. And those who can sort of see that dotted line to, okay, this is what's happening today. And so therefore, in the future, we can design this really new future that hasn't existed before. That's a new possibility. So what I'm looking for founders is VCs are not supposed to be the ones who create those dotted lines. Otherwise, we should be founders. We're looking to the founders to paint that picture for us. And so at the very pre-seed early stage period, we're looking for, can this founder tell us what those insights are and start to design that out? I'm an investor in Pop Shop Live, and she was the last in-person meeting that I had before shutdown happened. And she was painting this picture of retailers and why they might want to live stream. And this was, before we understood what the impact of COVID might be, but it was clear that there are many retailers that wanted to do that. And so at that moment, she didn't have a lot of retailers onboarded, but you could start to see why that's going to happen in the future. And so we want to have those founders make that dotted line for us and explain to us why this marketplace is the future.
Got it. And then Daniel, let's say a company raises a seed or a pre-seed and they're now looking for an A and it's a marketplace. What areas do you kind of focus in on before you green lighting an investment?
Yeah. So from a founder's perspective, everybody wants the simple answer. What do I need to bring you in order to get your money? And they all wanted to be formulaic, and I understand. And frankly, I wish it was formulaic too. But it's actually not that simple. And so the questions that I get are, what is the minimum revenue figure you need? What is the minimum growth rate? What are the numbers that I need? And again, it's not that simple. It's contextual. And the reason is every business is different. Marketplaces, a SaaS-enabled marketplace behaves a bit differently than a simple two-sided marketplace, which is different from a three-sided marketplace. And the industry matters and the competitive dynamics matter. And there are just a lot of nuances. And this is one of the ways in which VCs is generally more art than science. But the common dynamic is that from an investor perspective, you need to be able to tell a story, and you need to be able to tell yourself a story that this company is going to change the world and have a massive impact on its industry, and ultimately be very lucrative for founders and for investors. And so, there are things that we look at in terms of growth rates and revenue figures, but again, that's just a piece of it. And so, at the Series A stage, as Anne mentioned, at the seed stage, you're looking for team is huge, and some hint of product market fit, and things like that. At the Series A stage, the story that founders should be telling is that the business is fundamentally de-risked, and it's a just add water kind of scenario, the water being capital. And if product market fit is established, and here are the various ways to show that the product market fit is established, is in the form of customer references. If it's a B2B business, you need a handful of customer references where they freaking love the product. If it's B2C, you need that as well, but you're also looking at cohort data that shows high retention rate over time, which is a quantitative way of showing that customers love your product. And then you do need a certain level of growth, call it 10 to 30% month over month, depending on what the base is. You need the large market size. You need a team that feels special, and by special I mean not just good, not just great, but really uniquely amazing. Just the kind of team that feels like they can change the world. So there are a lot of things that go into it. Every investment is kind of like picking a spouse. You've got this long laundry list of things that you look for, and qualities that you find attractive. But there are a lot of boxes that need to be checked, and hopefully, of course, it's also a fit on both sides. The founders need to feel good about the investors they're working with.
Yeah, and sometimes investments last longer than marriages as well. So you definitely want to spend time diligencing, which is actually a good segue to a question, which is kind of flipping the panel topic. What would you recommend founders focus on when they're looking at VCs, and which VC to really kind of pair up with and accept their term sheet and accept their capital? What are kind of the common mistakes that you see? What are the best practices that you would recommend that folks on in attendance take into account? Daniel, do you want to take that one?
Yeah. So I think capital is a commodity, and everybody's money is green, and so the question is, what are the intangibles beyond the cash? And hopefully, if things are going well for your business, you've got multiple opportunities to choose from. You need the personal chemistry with the investor, because this is a long-term relationship. It's very hard to divorce your investor. Typically doesn't happen really ever. And so, you should front channel and back channel investors you're considering working with. But in addition, unique expertise and add. And so it's a fundamental premise of our firm at Autotech that we do have this unique network within the ground transportation industry that frankly generalist VCs don't have. And we love generalist VCs, and they're amazing. Because they don't spend all of their time focused on our industry, they just don't have that depth. And so we provide something unique, and we recommend that for that unique either skill set or Rolodex or experience that an individual might bring to the table.
Got it. Awesome. Yeah, and that actually answers one of the questions that came in from the audience as well, which is what is your role in the success besides funding? So thanks for answering that. And with the time, we're getting a ton of questions, so I'm actually going to transition to the Q&A section with the time that we have left. And again, feel free to continue to send questions. Question for Anne to you. The question from the audience is, when looking at regulatory changes for pre-seed companies, is there a time frame that you use for evaluating those changes? What does that process look like?
Yeah, so some of it is based on what we are trying to evaluate is the regulation one that fundamentally I agree with, that we think is going to stay there for the long term, or is it really sort of protection of an industry? Generally, when we think of it as sort of protective regulatory changes that we need to have, so like with like taxi medallions, we were a little bit more skeptical of whether or not those would maintain. But like with safety regulations, we believe that we needed to sort of outperform what was in the market at the time. We think of challenging regulation in different ways. And so at the very early stage, the kind of regulatory risk that I'm not going to take, which I have taken in the past, is sort of the bet that the regulation will change in our favor and allow a certain kind of a completely different type of business from a technology standpoint. So a good example of that was like we took a bet that the FAA would allow certain kind of drone behavior. And I did that in 2010. And I think like 4 or 5 years later, it came out that it didn't end up on my side. And so that was tough, right? That was a tough pill to swallow. And so I think what I'm trying to figure out is what type of regulatory change are we talking about? And what time frame do we believe that could happen in? And then what is the pull? So sometimes if you have real product market fit, the regulations will ultimately reflect what the product market fit suggests, or the regulators will want to work with those companies. But ultimately, if there's no pull from the consumer side, there's no advocates on the consumer side. And so it's really hard to get regulatory pull. And that's what we saw like with telemedicine. It was just sort of a required thing to be able to work within the pandemic. And so I think that's the reason we're starting to see these regulatory changes.
Got it. And then Daniel, a question for you from the audience. How early should founders start engaging with investors to build relationships? And what's the kind of best practices in trying to build that relationship and even contacting and connecting with investors?
Yeah, I think probably the best practice in my opinion. So first of all, different investors are people, so people are different. They vary. And different people have different preferences. That said, what I think would be among the most valuable things you can do is to connect with investors, start building the relationship, and ask them for feedback on the company, and say, what do you like and dislike about my company, or what do you find concerning? And that's in many ways an easier conversation than will you fund me or not? Because oftentimes will you fund me or not simply leads to no. In fact, realistically, that's about 99% of the time. Investors just say no, and sometimes they provide feedback, and sometimes they don't. A lot of times, frankly, they don't. And I personally try to, but it's not universal. But if you have a more exploratory conversation and you're just pitching them and chatting with them, sorry, not pitching them so much, but more chatting with them and asking for feedback and say, what do you think? Not even what would you think about my company, but what do you think other investors might be concerned about with regard to my company? You can get some very helpful answers with a question like that. So that would be my advice.
Anne, anything to add to that?
Yeah, I mean, I like actually developing a relationship pretty early on. As Dan made the metaphor, it is basically like a marriage. And so you don't want to have someone come in and say, hey, you have 24 hours to make a decision. That basically turns into a no for me, because I recognize actually, my relationship with Lyft has lasted 10 years. And so it just needs to be one where I understand what the chemistry is. They understand sort of what I'm looking for, and what style I have. I know the style that I have of working with founders is not for everyone. And so you need to make sure that you have the right partner working with you. Otherwise, you'll just be miserable, and no one wants to be miserable.
No, and in the COVID world, are you leaning on investing in folks that you knew pre-COVID, or if not, how are you getting comfortable with that relationship building in a virtual setting? I'll let Daniel.
Yeah, I mean, I'm investing in people that I've never met before. Okay. I have 2 investments. One actually set of founders that I've only met through Zoom. They're in Virginia right now. And so I've never actually met them in person. One that I met after I made the investment, but we had several meetings together just to make sure that we knew how we would work together, what we agreed with and what we didn't agree on. And so I think, for me, it's more important, like, how do we actually work through things that we don't agree on? So I'm usually focusing on what are things that we disagree, and how do we actually resolve those disagreements even before we make the investment?
Daniel, what about yourself?
I think everybody these days is making investments via these Zoom chats. There's no way around it. It does increase the amount of diligence slightly that you might do in other forms, front channel and back channel, to further flesh out your perspective on someone. To echo Anne's previous comment, the prospect of having to make a decision in 24 hours, I hate that, and it also leads to a no from me. But it's surprisingly common. I think it's so rare for me to not hear from a founder that I have to move quickly. The deal is moving, and can you give me an answer in 3 days? No, I can't give you an answer in 3 days. It's not because I don't want to. It's just because I have a calendar full of meetings. I've got other projects going on. I've got an entire portfolio of companies to support, and I need to be responsible to my LPs. Now, at the same time, we try to move as quickly as possible, and so we can get a deal done. We have gotten deals done in a matter of days, in a few weeks when necessary, but it doesn't always lead to the best outcomes for either side. I think these are long-term relationships, and whenever possible, it's best to develop that relationship on both sides.
Yeah. So we only have a few minutes left. So I'd like to end with a little bit of a forward-looking view from both of you. How have valuations and kind of the market evolved in 2020? And then what do you see kind of for 2021? What's your early view for 2021? Are you bullish, bearish, neutral? If you could focus it on marketplaces, that's great. Otherwise, just a general view on the kind of venture capital activity for 2021. Any closing thoughts on it?
I think that. Oh, go ahead.
Go ahead, Anne.
Okay. I'm incredibly bullish. I think that so valuations are way higher than I would have ever expected in probably March or April timeframe, and they continue to get a little bit crazier. And as I said, I'm probably more conservative on the valuation front. Most people are not working with me because I am providing them with the highest bid in the auction. And this is part of the reason that relationship is so important and getting to know each other is so important. But I think actually these trends will continue into 2021. The capital is quite persistent. And so the hot deals will remain hot. And so from an investment standpoint, the way I think about it is sort of looking where everyone else is looking and continuing to not just pursue the companies that everyone wants to invest in, but I think that especially at the very early stages, we win when we invest in controversial bets. And so those are the ones that I'm looking for, the ones where maybe a lot of people think that it looks weird or is a little bit crazy. Those are the ones that end up being special.
Awesome. Daniel, 1 minute left. Close us out.
Yeah, well, I agree that the valuations seem very high right now. We were joking internally that it seems like every company we see has a valuation expectation of $100 million these days. And but at the same time, there are amazing businesses out there, and people keep getting better at building amazing businesses. And so one thing we've learned is that for the right team and the right market opportunity, it's important to pay up when necessary and get in the deal. So I think valuations are high. I wouldn't be surprised if they fall over the coming year. Perhaps in in synchrony with the stock market. We'll see how that goes. But in the meantime, there's a ton of innovation, and frankly, Zoom has its downsides, but it's also making a lot of things more efficient. And so overall, I'm very bullish on the opportunities available in ground transportation and otherwise.
Daniel, Ann, thank you so much for your time. We could have spent hours talking about the market and marketplaces in general, and just the overall sentiment. I appreciate your time and sharing your knowledge to the audience. Thank you so much.
Thanks, Al. Thanks, Dan.
Thank you.
Thank you.
Thanks.